This is a Brooklyn-bound 2 train. The next stop is Wall Street.
Stand clear of the closing doors, please.
Hey, Simple Side, how are you? Happy Sunday.
I'm good, thank you. We had a lot of technological trouble here, but we figured it out, so I'm glad we're finally going to get going.
Yeah, it's always with video calls and recording. So we finally figured it out. I'm happy to meet you virtually finally because we are both recommending each other on Substack. And we got together with the idea of potentially doing this podcast interview session with each other after I had made a post about the 10-year falling. This was about a week ago, that the 10-year was falling with the technology sector falling as well. And I said, I don't have to look. Bonds are most likely higher. XLP is also likely higher, question mark. And then you replied, I've gone long bonds with tickers like ZROZ, TLT, and TMF in the past. What do you think about doing a podcast on this topic? And I'm tired of just hearing about my thoughts. So we both DM'd each other and thought it'd be a smart idea to get together on this podcast. So thank you for your time on the weekend.
Yeah. Thank you for running through the whole spiel in the beginning too, setting us up. So yeah,
absolutely. And so for my audience for the podcast and Substack who may not have heard of the Simple Side, if you can give me kind of the elevator pitch of what Simple Side is about on Substack and a little bit of background information about yourself. And I'll do the same since we will most likely be sharing this with both audiences.
Okay, perfect. We talked a little bit before we jumped on the call, so I'll stay somewhat short-winded. And if you'd like me to go more in depth on anything, I'd be more than happy to.
Okay, cool.
So basically what I had told NYU offline before we jumped on is I kind of started the Substack when I was in college. I kind of got fed up with spending all my time working on projects. I was a business and economics double major when I was in college, and I got tired of just spending all my time producing great work for an A in a class. And I felt like that just wasn't enough for me. And so I kind of wanted a place where I could report all the same things that I was doing for my schoolwork online and just kind of put it out there. I didn't even really think I was going to be able to grow an audience at all. That's just kind of where I was. I didn't even realize that you could go paid with stuff like this. And so I was also kind of the stock guy in college. I was always talking to people about this company or that company and what they were doing and how they were growing and the investments that I had made. And so I also kind of wanted a way to track and prove to people, hey, I'm saying this to you, but I'm also doing this and it's working and my portfolio is growing. And I just kind of wanted proof. I wanted to be validated almost that what I was doing was worthwhile. And so that's kind of where my Substack came from. The name, The Simple Side, came from the fact that every time I would go to find a newsletter to read or anything at all to read about, there was just so much jargon that was involved with everything. And I found myself in like investopedia.com or whatever that website is, looking up all the terms or looking up what this means or what that means. And so I figured, well, if I'm going to do this and I'm kind of a newbie, I'll both explain it to my audience and explain it to myself simply. And so that's kind of where the Simple Side came from and how I got my start. Again, this was kind of all right when COVID stuff was happening too. So I had a lot of time to put into the newsletter and help grow it in the very beginning. But that's kind of my background, at least surface level.
Yep.
I'll let you get into you.
I'll give a little bit of background about myself. Obviously, my audience already knows this, but for the Simple Sides audience, so I started the Substack right before the COVID lockdowns, and I started the podcast last year, July. And I'm pretty much checked out of the W-2 world. I'm a little bit older. I'm in my mid-40s, and I've had some success and fortune to be able to exit a few tech companies, one being acquired by Adobe, worked in a global role at Adobe for a few years, and I've had this fantasy of not being in the rat race anymore. And I was already managing not only my portfolio, but also my family's. And I wanted to give it a go, take a few years off and just trade full time. During that time frame, the itch to create content and pass down what I know was getting stronger and stronger, especially during the COVID lockdowns. And I wanted to be able to put forth the framework in which I invest and trade, because those are two different things, in a format that's digestible, so that I can ultimately pass down to my family a living and breathing uh, work, so to speak, available on Substack and podcasting. And then the podcast I started because, uh, like you, I was looking for a product that didn't exist. And I was searching for a quickly digestible podcast, 15 minutes a day, that I can get a download of what happened in the markets while I'm walking the dog or while I'm on the treadmill without any advertisements or politics. And it just did not exist. So I said, you know what? I'm going to just start like a ham radio podcast every day. And that's kind of the background of how I started the Substack, as well as the podcast.
Yeah, I think that's awesome. I mean, I listen to your podcast every once in a while too, just checking in and see what's going on in the market. So I enjoy it as well. It's definitely worthwhile for just about anybody.
Thanks. I really appreciate it. And I was listening to actually your latest post and podcast as well, Simple Side. And congratulations on launching of Copy Trade. Could you kind of give a quick overview of what Copy Trade is, and who would be
Yeah.
the ideal audience for that service/product?
Yeah, for sure. So basically, and we talked about this offline again, so I'll try to hit all the points that I said earlier. But basically, what we had talked about is there's a lot of people both on Substack, off of Substack. You'll see a lot of them on YouTube.
Yep.
People like Ty Lopez, who send out a lot of these ideas into the world, and they kind of just sell you on a lot of things. And they're always selling you a course, or they're always selling you X, Y, and Z. And you always see them flashing fancy cars and money. And then eventually it always
Yeah.
comes out that whoever it is that's flashing all this stuff, it's all rented, or the cash that they're flashing isn't real. And so they all kind of just love to live in this fantasy land of how great they are. And then it always comes out in reality that all the money that they're making is coming from the courses that they're selling and not the investments, or the business that they have said that they're making their money from.
Right.
And so that started to drive me a little bit wild. And I really got exposed to it when I joined Substack. And I ran into a couple of people that were just kind of shilling portfolios, if you will, or things on here that just didn't seem like they would actually make that much money if you invested in them now, and everything was back tested, which we know is never indicative of future returns. You hear that everywhere. And so I kind of decided to put my money where my mouth is, so to speak, and say, hey, I'm going to put my portfolio together, and I want you to be able to copy it one for one, see the returns one for one, see the trades that I'm making one for one. There's no way for me to hide it. And so I've been looking for a brokerage forever to partner with, and I finally found some guys that are going to let me set this up and put it together. And so I'm releasing this as a beta test to a couple of my paying subscribers first. And if things go well for them, just onboarding experience and whatnot, then I'm going to end up sending it out to my entire subscriber list. And of course, you'll have to be on the paid side of the Substack to join this. Just another benefit to people that have joined my paid. And they're going to be able to go and copy all the portfolios that I have one for one. So that's where that came from. And I'm really excited about offering that. And I'm hoping in the future to bring more people on to join me on the platform. And I've spoken with the guys that I'm partnering with, the brokerage that I'm partnering with. I've spoken with them about bringing other people on, and they're very open to the idea, and they're looking to grow heavily, especially this summer. And so I'll be reaching out to people like NYU Grad to see if they'd like to put portfolios on there for other people to come on and copy. And I'm excited to do so.
Yeah, that's great, man. And I wish you the best of luck on that launch. I certainly am all about transparency, especially when there are services that are like, trying to help direct portfolios or offer specific trade entries and exits and et cetera. So that's an awesome service. And I hope it does really well. I'm sure you'll do well with it.
Yeah, and the one thing I didn't mention that I probably should is I'm not going to be taking any fees from anybody's portfolio either. So you're not joining the platform and then I'm taking a 2 and 20, or I'm not taking even a 2, or I'm not taking a 20. I'm taking nothing. So it's really just to prove that everything that I'm doing and saying is actually happening, and to just kind of stay away from that space where you can say things that aren't actually happening or aren't true or aren't provable. So that's all that it is.
Cool, man. That's great. I'm glad I caught the launch of that today, and keep me posted on how it goes.
Yeah.
So let's kind of take the conversation a little bit more broader stroke. So we're talking a little bit about our background and our core offerings on Substack. I want to also kind of walk through with you your thought process on where you think the equity markets are today, and I'll kind of chime in as well. But I would love to hear your thoughts where you see the markets.
Yeah, and it definitely goes both ways. I'm excited to see what you have to say, but I think in tandem with a lot of other big movers in the market, I think we're pretty close to a top. And there's so much volatility that we see in the markets, and everything that we're looking at is so speculative now. Investing back in the day, especially long before commission trading, was so based on people finding businesses that they believed in that were going to grow and that would make them a return. And now it's not so much about finding a business that they think is doing well or growing. It's about finding what company is going to make me the most amount of money in the fastest amount of time. And that mindset works wonderfully in the short term. I mean, we've seen the markets run crazily since COVID, especially when a lot of people started joining investing platforms when they were locked at home and had nothing better to do.
Yeah.
And so the market started running wild, again, with speculative capital. No one's really investing for businesses now. No one's doing deep research other than going and checking out their favorite Reddits and investing there. And so I think we're pretty high. I mean, if you look at the total market cap relative to GDP, I think we're at 200%.
Yep, that's correct. It's over 200.
Yeah, over 200%, which is levels that I don't think we've ever seen before. I think in November we were at 204%, which I think was the highest that it's ever been. And we're sitting around 202 or 203 right now, but you can correct me if I'm wrong on that.
Yeah, no, we're definitely at all-time highs on the Wilshire 5000 versus GDP, or the Warren Buffett indicator.
Yeah, and so if you take that and you extrapolate it out to expected returns, if you look historically and build models off of that, you're looking at a 0.2% expected return for this year.
Yeah.
And so when you look at things like that, it's hard to say, well, I know better than the numbers. So I don't know. It's challenging for sure to look at something like that. And there's other weights that have been built as well. You can look at something like total market cap over GDP plus the total Fed assets. And I think that percentage sits at 163%. Again, you might know the more up-to-date numbers than I do, but even that sits you at a 0.3% expected annual return. And so it gets scary when you start to look at numbers like that and you look at the market and everything seems to be extremely overvalued. I look at stocks that are, again, speculative, like Palantir, which I think was trading at one time at 600x PE.
Yeah.
And so it's so unreasonable. And the one thing that really scares me, especially now, which is why I've started going long bonds, and we can get into that later, but when companies have these really high growth targets, which almost all of them do now, and they hit those really high growth targets, there's really no change in the stock. You should be seeing crazy numbers run up in these companies. But since everybody's already speculating for those massive gains, they don't run up at all. They just kind of remain even. And when you look at a company, for example, like NVIDIA, who had somewhat on par earnings recently, on par isn't good enough anymore. NVIDIA dropped something like 6% by the end of the week, and I think was down 9% at some point during the week. And when you have missed earnings, you can only imagine how down these stocks are going to run. And so it gets really scary when you get to that level in the market, and you really need to be looking for quality over speculation.
Yeah, no, that's a great. I'm glad you cover a lot of bases. It shows me you have a good grasp of macro, which that's something that I think a lot of investors and traders don't have a good grasp of today. So kudos to you.
Thank you.
And I kind of agree for all of the reasons that you've cited that I've also shared with my readers, but some new things or additional things that I want to add to those, because I agree with all of those. There is a company called Lisbeth that measures the true rate of unemployment by adding those in the U.S. that make under $25,000 a year, calling that demographic as structurally unemployed, right? Like if you make under 25K a year, let's just consider you unemployed.
Mhm.
And if you do that, the rate of unemployment today is 24% in this country. And that's 1 in every 4 people.
Yeah.
I mean, and I rarely ever get political because everyone is so, at odds. But I think that has a lot to do with what happened in November. And you and I, we see the financial media and the news flow, like things like Nvidia, and we're trading off of like fake data that comes out every week from the
Yep.
government. So that's just one line item that I track is that true rate of unemployment, which is just horrific. And then I'm sure you can agree if you look at consumer debt, it's at record. The APR for that consumer debt is at record levels.
Mhm.
Margin debt for trading accounts is near all-time highs.
Right. Yeah, and when you see stocks like MasterCard and American Express and Visa also running and just having incredible record earnings and seasons, as much as it's wonderful, excuse me, for everybody that holds those in their portfolio, it's terrifying to think about where the money for those companies comes from. And like you said, it's all debt and it's all consumer debt. And I think we're seeing a little bit of that pan out now as we're watching consumer spending drop. So again, and like you said, with the numbers, the fake numbers that are being reported by the Fed, we've seen negative revisions, and not in negative directions, but negative revisions, meaning inflation is always higher when they revise it. Everything just goes negatively when they revise, but no one pays attention because they revise 3 months after they send those numbers out. And I've talked about this in the past. Those revised numbers are what affect the future so much more. And it's wild.
Yeah. Yeah. So I would agree with your take. I think it's really, I think the time to hedge your long-term portfolios, right? And I think it also depends on the investor or trader's age. So,
Definitely.
when people ask me, even my friends and family, it always has to, you always have to start with what is their time horizon, right? Are they 60? Are they retired? Are they 21? So I think it'll be different feedback and advice depending on who asks me that question, like what I think about the stock market. But just on the macro lens, I agree with you that in the near term we might be oversold, but in the big picture, we're definitely overbought.
Absolutely. Yeah, absolutely.
So I think we may bounce here, maybe like in a week or two, but I think the risk really is to the downside with all of these headwinds that you and I just kind of peppered on
Yeah.
that conversation.
Something that I've been paying attention to as well is, as much as everybody hates it, we love to see Bitcoin and the market actually trade in tandem.
Mhm.
And I'm not huge on crypto, and I think some of the stuff that's happening in the crypto space is crazy, but every weekend I watch what happens with Bitcoin, and you can almost 1-to-1 predict what's going to happen market open with the SPY. And I don't know, you might not agree with that sentiment, but I watched today Bitcoin run from 85,000 up to 95,000. And that actually has happened, I think, just over the past couple of hours. So
Yeah, that was on Friday.
Yeah, it's so Friday. I mean, I don't even know what it went down to Friday, but
81.
Friday went down to 79,000, I
Yeah, it was
think.
like 80, 81 or 70, something like that. It was close to around 80,000.
Yeah, and this morning, I think at around 9:30, Bitcoin was sitting at 85,000, and as of right now, it's 95,000.
Oh, I didn't see that today.
Yeah, so just in the past couple of hours, it's run up 10,000. So we're probably, I mean, this is what I'm talking about with this speculation. I mean, it makes no sense. It's so wild. I mean, so yeah, well, like you said, we'll definitely see the market probably jump this week or next week. And you're probably going to see a lot of outflows of smart money. And then there's going to be a lot of people left holding bags.
Yeah. And I don't know about the correlation 1-to-1, but I would agree that the futures market, like the S&P futures or the NASDAQ futures, for sure has been tracking Bitcoin and animal spirits there for sure.
Yeah, I probably shouldn't have said 1-to-1, but there is sadly there is a correlation there. It's just
Oh yeah, for
shows
sure.
the speculative nature that's happening in the markets right now.
Yep, for sure. And then specifically on the comment that you had shared about the bonds, like TLT and a few of the others,
Yeah,
like ZROZ and TMF. I'll start first here.
please.
I actually like TLT. And I also like LQD. Not exactly the same. Like LQD is more like high quality corporate bonds.
Yeah.
And then TLT is obviously the treasuries. I personally like LQD kind of like at the beginning of an expansion cycle, right? Because corporate bonds are the underlying are the companies that are issuing them, right? And you want to make sure that they're quality.
Right.
But at the end of an expansion cycle, if what you and I are saying is more accurate than not, I think TLT will see a higher uptick in rotation
Hmm.
when we see rotation into safety versus the LQD. Because if you look back at the Great Financial Crisis or even a few of the other downdrafts, everyone assumes that gold is where to go. And if you look at the performance of gold during the GFC and the initial uh, wave of selling, gold actually fell just as hard as the Qs or the SPY. And during that initial panic sell off, everyone rotated into TLT because they're betting that the government won't default on that.
Right.
Um, so that's kind of where I'm at with TLT. I think it's a good hedge for where we are right now, but I would love to hear your thoughts on like Z. I've never even heard of ZROZ.
Yeah. So the only reason that it's for those that don't know, the way that bonds are priced is relative to the rate that they're paying out. So in very simple fashion. So basically, if rates are going up, bond prices are going down. If rates are going down, bond prices are going up.
Mm-hmm.
So that's just the quick and dirty on bond prices. And bonds pay a sort of dividend. They call it a coupon.
Mm-hmm.
And that coupon rate also affects the price. And so for something like TLT, both coupon rates and interest rates are affecting that bond's value. Whereas ZROZ, which a lot of people don't pay attention to, like you said, a lot of people don't know about this. It's a zero coupon bond. And so it's solely affected by interest rates. So there's no coupon rate that's playing into it, which makes it a little bit more volatile, a little bit more risky. But like Buffett always says, I mean, if you think you're right, you kind of need to go full bore, is the way that I view it. And so if I think that people are going to rotate into safety, and I think if rates are going to end up coming down, if I think there's a meltdown in the market, well, I want to be in the asset that's going to reap the most reward. And for me, that's ZROZ. And then of course, TMF is like the all-time risky bet that you're 100% accurate. It's a 3x leveraged bond ETF. And so
Got it.
those what those two are. And so in my head, I'm just like, if I think I'm right, do I go half in that I'm all right, or do I go 100% in that I'm all right? And so if the stars for me really align and I see something where I'm like, okay, there's no other way for us to go other than rates coming down, then that's when I would rotate into something like TMF and make my bet there. But I think there are, like we both said, I think there are some headwinds to that being a 100% sure bet. And so I haven't rotated into TMF fully, but that's really the only difference for me, at least for ZROZ and TLT.
Got it. No, that's great educational primer for me. Does TMF offer a dividend yield, or is it simply just tracking that via price?
Yeah, I mean, don't quote me on this, but I want to say they also pay out the yield that the bonds should be returning. But that
Okay.
could be wrong. So don't quote me on that.
Okay. Yeah, yeah. I'll do some homework on that as well, since I've never heard of about TMF or ZROZ. Cool. Thank you. I appreciate a little bit of that education on that. The other thing I wanted to kind of pick your brain about is the AI story. Obviously, when you take a look at where the markets are, like even after 2022, we were starting to sell off, if you recall, and
Mhm.
then it was like one day the flip was switched on Bloomberg, CNBC, and all news. Like it's just going to be about the AI story, and the market exploded higher on it. I would love to get your take on what you believe where we're at with the AI cycle.
Yeah. I mean, again, like I feel like anything that's related to AI right now is so speculatory. So for me personally, in my investing, I've actually tried to stay away from almost all of it.
Mm-hmm.
I just it's so hard for me to go look at and properly value a stock when when everything that's there basically tells me like there are people making wild bets in these companies, and I want to be in a realm of things that I know about, that I understand. And you know, I don't understand why SoundHound AI goes crazy and then falls when their earnings don't do well. Like, you know, that just doesn't make any sense to me. And I don't want to play in the speculative markets.
Yep.
Again, like I don't want to buy a stock where it hits growth targets and then we see a 10% decline.
Right.
So I try to stay as far away from that as possible. I'm sure that those companies have room to run. Again, running on speculation,
Mm-hmm.
but they definitely have room to run. We're going to talk about this a little bit later. We're going to talk about some bullish and bearish ideas that we have, and I'll get into a little bit more of what I have related to AI when we talk about that. But I'm not the biggest fan. I'm sure you probably have a little bit more research and better knowledge of the space coming from the tech sector, so you might be able to speak to it better. But I'm afraid of the money that's going to be lost when some of these companies underperform.
Yeah, and you're I love how you're honest about why you're staying away from it. And I think you're doing the right thing because it is a highly narrative driven sector of the market where it's all about the story, right? But on the flip side, I can't discount that they are like a lot of these Mag 7 companies are spending a lot in capex and buying these chips from Nvidia, and those data centers are being built.
Right.
Uh, but on the flip side is how long can they keep spending the money to do these build outs to the point where they're not getting a return on investment?
Mm-hmm.
And what is that going to impact their future uh, balance sheets? And one thing that I wanted to share with your audience, if they're listening, is that it's important if you want to read about AI, or there's so many headlines about AI. I would say 99% of the headlines are bullish. It's important to even out uh, that lens. And one Substacker that actually does a really good job of this is Gary Marcus, and he's a written author. He sold a few companies, and he writes about uh, AI in a much more realistic way. And he'll, actually show screenshots of him testing ChatGPT 4.5, as well as Grok 3 and all that stuff. And he's on the other spectrum where he believes that scaling laws are not going to be taking LLM AI, language model AI, to the promised land, and that he feels that we're already at the wall of diminishing returns. And in order for AGI to exist, these companies like NVIDIA, like Google, Amazon, Apple, etc., are going to have to completely move away from LLM to something completely revolutionary that may not even exist today. And that is a scary thought for a lot of these mega caps that have invested billions of dollars in LLM.
Yeah, I agree. And I've had a lot of personal conversations with people about all of the AI investment that's going on. And my knee-jerk response and what I tend to tell people is I don't expect very many companies to make excessive profit off of any sort of AI that currently exists. I really think that AI for now is only going to be good for cost cutting. And so if you're looking for a way that AI is going to affect companies, I would look for companies that have really high CapEx or really high spend, and they'll be able to cut some of that down using AI models. And that's just my opinion. And as far as my knowledge goes, that's kind of where I sit with it. But again, like the fact that these companies have to shift, like you said, entirely away from what's currently happening is scary. And a lot of them aren't so nimble that they will do that easily and willingly, especially when they've already committed hundreds and hundreds of billions of dollars towards investing in the current state of everything.
Yeah, and I'm not, and for anyone who's listening, I'm not saying either I am right or if Gary Marcus is right,
Right.
but he makes a very compelling case, right? It's almost like a lot of these companies invested a lot of their capex on, let's say, the DVD, right? They're building their infrastructure on DVDs, but the next thing is going to need to be streaming on Netflix, right? Like, that's a big jump where all the money you've spent on the LLM infrastructure might not translate, and you might have to spend again to the next thing.
Exactly. Yeah, exactly.
Yeah. Okay, cool. And then I think that's a good segue for us to kind of peel the onion on what are some good bullish ideas or bearish ideas we can share with the audience at not behind the paywall, just like thinking out loud.
Yeah, I mean, like I said, so everybody's in AI right now, and one of the ways that I had great performance in 2024 was betting on kind of secondhand effects, is what I call them. So when I was looking at, I can't even think of something right now. When I was looking at wages coming up, when people were saying they were going to raise minimum wage, when states were raising minimum wage, I realized that companies were going to have to obviously start cutting the workforce. Just because minimum wage goes up doesn't mean that they're suddenly going to start charging more for their product, because supply and demand and cost and everything are so intertwined. They have models, that tell them, hey, if you raise your prices, you're going to lose so many customers, and total revenue is going to drop from that. And so I thought companies were going to go into robotics, and so I made some bets on robotics companies back then that all performed really well.
Mm-hmm.
And I'm not going to talk any specific tickers, but you can go and find them on my newsletter from 2024. And so I made some bets there, and they did really well. And so what I have now is this infrastructure that everybody's betting on right now, that everybody's playing speculation in, is AI. But AI needs crazy amounts of energy and crazy amounts of water to run. I mean, the stats on how much water it takes to run a data center is wild. The energy that it takes to run one of these data centers is wild. And I started reading up on data centers that were going to get it built. And the example that comes to my mind is there's one outside of, I want to say, Lancaster, Pennsylvania, that requested access to plug into the grid, and they basically got turned down. It was going to make electricity too expensive for people that are in the area. And then also they thought that the data center was going to have too much of a draw of power, and they weren't going to be able to support it. And so they didn't let the data center plug in to the grid. And so I'm seeing things like this happen. And that's just one example. It's happening in multiple places. And so I started reading up on Doomberg. For those of you who don't know, he's one of the first and foremost voices on energy that exists on Substack and probably in the energy realm. I read up some articles that he had put together about the same type of deal, where data centers were getting rejected from plugging into grids, and the power that they were pulling was just astronomical. I think one of the craziest stats that I read from Doomberg is that a Google search takes 10 times less energy than a search on ChatGPT. And so my mind just started exploding about energy. I was like, this is wild. And so my free bullish idea is basically to bet on all the companies that are going to have to power all of these data centers that are coming online today. And this isn't a 1 year bet or a 2 year bet or a 3 year or a 5 year. This is like a 10-year bet that will pay off, in my view. Again, this is just in my view, in astronomical ways. Some of the companies that I'm looking at are building things called SMRs. These are just basically like nuclear power plants, but on a much smaller scale. They don't have as big of a footprint. They're quite a bit safer. For those of you that don't know, the technology that we have in nuclear power generation has come so far since accidents like Chernobyl. And somehow we have it kind of twisted in our minds that these power plants are extremely dangerous. The technology has been developed so well. They've come so far. They're some of the safest ways that we can actually build energy now. We just aren't up to date on all of the tech. And so I have a very long-term bet right now. It's one of my highest conviction trades on multiple companies that are building these SMRs out. It's my long-term bullish idea. And like I said, it's a 10-year out win. And so a lot of people aren't looking for that time horizon, but I feel like the returns in that area are going to just be incredible.
Interesting. My free bullish idea, I would say, rhymes with what you're saying. Is I'm just going to name the ticker because I've already written about it as one of the dividend stocks that I've recommended in the past. Is Energy Transfer, ticker symbol ET, like the movie ET.
Yeah, go directly in line with what I was talking about.
Yeah. So, nat gas is very volatile. They call it the widowmaker for a reason. Natural gas is in a very wide range between like $1.7 to like $9 BTU, and we're right at the midway point. So this is going to be highly dependent on natural gas prices. ET, or Energy Transfer, is one of the largest exporters of natural gas from America. Obviously, there's also some tariff export rules and regulation things that could potentially impact them as well. But they pay over 6% dividend yield. And if, like what you're saying, energy is going to be a shortage for these data centers, to kind of transition that the bridge from what we have in the grid to potentially nuclear. I think natural gas is the bridge, because like if you look at what Elon Musk built down in Tennessee, he used natural gas off grid, so he didn't have to plug in to the local grid. Yeah, it'll be interesting for sure. And then let's kind of close out with a bearish idea we could share with the audience.
Yeah, definitely. I'll be quicker on this one. I know I'm very lengthy. I love to talk. So I'm still pretty bearish on real estate. I think you brought this up earlier. I might not have touched on it, so that's on me. I recently read an article that there was companies that were getting, there were commercial real estate buildings that were getting sold at a 68% discount to their prices in 2017. And this kind of stuff is crazy. These were a pair of offices in Manhattan. It just like huge discounts. And I've been seeing this all over the place. And I used to write about real estate a bit more. And I have a brother that's deep into the real estate game. And so he used to be kind of my somewhat advisor on those articles. And I've focused more on the equity markets since then. But these crazy discounts on commercial real estate is scary for me. I haven't done my research into it yet, but I would say if you're going to go through and look for a real estate investment trust that you don't like, I would go look for anybody who's got debt that they pulled post-COVID to buy COVID priced property. So anybody that's pulling high interest rates and buying these properties that are incredibly overvalued. Of course, all those overvaluations coming during COVID. Any REIT that has all of that on their books is scary to me. The other thing that I think is scary is kind of what I touched on earlier, but business service companies. I think, like I said before, AI is going to be great for cost cutting. And I think one of the ways that a lot of businesses are going to cut costs is by replacing business services with AI. And again, I wish I could speak to this more. I haven't done my research enough to sound intelligent. And so instead of sounding like a bumbling idiot, I'm just going to put those out there. Those are both places that I'm actively looking at stocks to short.
Got it. I appreciate that. I think if I had to give a free bearish idea, it would be it's quite interesting because it's semi-related to what you just said. It would be non-bank financial institutions, because what has changed from the GFC is that a lot of the banks that used to be our mortgage providers, like, Washington Mutual, who had to get, absorbed, and many others, they used to own the paper. And now, outside of Fannie and Freddie, you have these, which is the government, you have these non-bank financial firms who are the mortgage servicers. And I believe that they're at risk once the doo-doo hits the fan, because they're not going to be able to get bailed out like a bank.
Yeah, exactly. There's no one relying on these companies that make the government say, hey, we need to keep you afloat.
Right. It was a way for the banks to offload the risk to someone else.
Exactly.
So there are a few publicly traded ones that I would potentially look for. And then just housing in general. Like if you look at a lot of the builders, like Lennar, D.R. Horton, Toll Brothers, they are the only seller right now because they can offer rate buy downs, but their inventory in the Sun Belt is getting to a point where they're going to run out of buyers at this price.
Yep.
Even if mortgage rates go down, I suspect they're going to have trouble filling the inventory of buyers, and that's their only job, is to build homes and sell homes. And I think their margins are going to compress tremendously because every buy down for rates or free refrigerator or free pool, it's all coming out of their bottom line.
Exactly. Yeah, exactly. I looked at KBH not too long ago and kind of had the same feeling. If you're looking for a short-term play, you could look at whoever ends up rebuilding all the properties that were burned down in California. But even then, I mean, that's not sustainable growth. It's going to be rough for all of those builders.
Yeah, I have friends out there. I know we can talk about it. I just don't know how that rebuild process is going to take over 10 years.
Yeah. It's it's scary.
But I want to end on a positive note because
yes,
that's
please.
the worst thing we could talk about. So just for those that are listening, I will be editing and publishing this podcast interview with special guest Simpleside. If you have any questions, you can find, just kind of reiterate where they can find you, Simpleside.
Yeah, so of course I'm just on Substack, thesimpleside.substack.com, or you can just Google The Simple Side and I should be one of the first to come up. I also have an off-platform website that you can go look at. It just tracks politician trading and insider trading. It has a little bit of information about my portfolio if you become a subscriber to the website, and that is thesimpleside.news. So you can find me there. Of course, my podcast gets put onto every platform, and you should be able to find that relatively easily as well. But the home base is thesimpleside.substack.com. And for my listeners, NYU, if you want to share where you're at and where they can find you, that would be awesome.
Yeah, thanks for that opportunity. So I'm at notyouradvisor.com. The podcast is daily. It's available on Substack, but also on a lot of the popular podcasting platforms like Spotify and Apple.
Perfect.
This was a pleasure, Simple Side. I really appreciate the time on a Sunday, and I hope to do it again soon. And I'll see you online as well as on Substack.
Yeah, right back at you. I look forward to more podcasts coming out and to watch and see if anything that we talked about plays out. I'll be sure to call it out in the future if what we said is wrong or right. I like exposing the things that I do wrong because they do happen, and I think it makes you a little bit more human to do so. But I hope they all come out on top, and we can turn around and say, look how great we were a couple months ago or a couple years ago.
Absolutely. All right. Enjoy the rest of your weekend, and have a great day.
You do the same. We'll talk to you later.
Later.
That's my train.
Stand clear of the closing doors, please.